Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hi, this is Beau Eckstein with the Investor Financing Podcast, and thanks for joining us for another episode. Today is going to be a short episode, and we're going to just discuss multifamily construction loans. Even in the market today, with the HUD program, you're able to finance your large construction projects. There's still an appetite. I'm going to go over the key benefits of the program. And if you have any questions, you can always reach out after this episode. There will be links below. And let's get started. So why HUD loans? Why construction loans with HUD? Well, first off, you've got a term that's typically 35 to 40 years on the construction loan. And during the construction process, for the 2-year build out, let's say, that doesn't start the clock on the 40-year term. So you got long fixed rate, right? So that's going to increase cash flow once the property is stabilized. In addition, you can get up to 85% loan to cost, LTC. Many times you can use land equity as part of your down payment. And then if you're doing an affordable project, there's tax credit that you can potentially participate in. So you can really get higher leverage than any other program out there. And the team I work with are experts in all the programs and all the tax credit programs. They can walk you through the whole process, and they can quickly analyze a deal and tell you if it's a good, viable project for HUD. On the multifamily component, they do allow for commercial space, up to 25% of the building area, as long as 15% of the income or less is derived from that commercial space. The other key benefits of the program are a declining prepayment penalty. Also, the loans are assumable. I think I touched on that earlier. So in an environment like today, where rates are historically low, you're talking in the twos. Let's say 6 or 7 years down the road, you decide to sell, right? Somebody can step in and assume that loan. Typically, it's about a 1% fee to assume the loan. And then they can, ride out the remainder of the long-term fixed loan. And so what does that mean? That means basically that somebody's going to pay you a premium to get that low rate, which will increase their cash flow. So it's an absolutely amazing product that a lot of people overlook because they think it's just affordable housing type financing, and it is not. They do luxury, they do market rate, along with affordable housing. And then this 221D program, it also works on heavy rehab projects, so it doesn't have to necessarily be a ground-up construction project. Construction work on an acquisition or existing facility is generally considered substantial rehab when the construction budget is more than $35,000 per unit. So that's what they consider. So this program would apply for a substantial rehab type project. Here's some more of the benefits. Maximum loan term 40 years. Could be for profit and nonprofit borrowers. LTCs and LTVs 85 to 90%. With tax credit and grants, up to 100% financing is possible. Construction interest is capitalized in the mortgage. Tenant types, market rate, affordable combination. Non-recourse from day one. One closing, interest rates are locked prior to construction. Converts to permanent financing automatically after construction. Can also pre-release units during construction. The developer can also be the GC and management company. They'd like to see the sponsors having experience managing similar size assets, but there's no net worth requirement or liquidity requirements. In today's market, you might be asked to come up with some interest reserves up front, but after 3 months, those get credited back. And that's just because what's going on with the market right now. Generally, HUD construction transactions is anything over $3 million in a market that shows growth or demand for housing or beds.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
Even if a market's tertiary, or if it's up and coming, or if the development is in a revitalization area, it's a good fit for HUD. So we can quickly take a look. Basically what we're going to look for is on a acquisition, if it's already a built project, right? We're going to look for 3 years of financials. So you need the 3 years of P&Ls, preferably 3 years of tax returns from the seller, and a current rent roll. And then on new construction, obviously, there's a lot more that goes behind it. And the process on an acquisition, not a heavy rehab. Typically, you're looking at 90 to 120 days from start to finish. And then for ground-up construction, 5 to 7 months, depending on if you're getting tax credits and things like that. But the process typically works like this. We get a summary, get financials, 3 years of historical P&Ls or tax returns. Just a basic summary of the project. If you have an OM, an offering memorandum, we take that. We can quickly assess if it's a good fit for HUD. If it's a good fit for HUD, we would give you a needs checklist of the items we would need. And then within probably about 2 weeks, we put together a document of about 20 pages and essentially have a meeting with HUD to see if that's a good fit. If the program's going to fly, and they basically either green light it from there. And if they green light it, then all the due diligence, all the third-party inspections take place from there. The company I work with, once they get the green light from HUD, they've always had 100% success rate as far as getting the loan funded. The only way something would ever come up if something on like a third-party report, let's just say it was an acquisition and there was substantial rehab that was not, put into place, then that, things like that could obviously offset it. But right now, for all the multifamily investors out there, I don't see a better program, for anything 3 million plus, with all the benefits of HUD. Sure, it takes a little bit longer to close, but if you want long-term fixed rates, this is the product to be in because it's the best pricing. You got a declining prepayment penalty. Typically, the prepayment penalties are about 10 years, and they're declining 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, right? There's ways to get shorter prepayment penalties, but that's going to be a different conversation. And basically, with the market right now, with a lot of lenders not lending, this is the program to really pursue, I believe. And it's pretty easy to assess. The company I work with, they've been doing this for 35 plus years. They've funded over $3 billion in transactions. They're one of the few kind of smaller direct HUD lenders out there. And they're able to kind of maneuver where some of the big boys aren't able to maneuver. and the service level, they answer their phones. So once we submit initial summary, we're getting fast responses. We're setting up conference calls right away. We're getting answers. We're seeing if it's a good fit. And my job is business development. I'm out there pounding the pavement looking for you so we can get deals done, and I can help you in your success, buying and managing and developing multifamily properties. And another benefit too, going back to the whole assumable loan component. I mean, if you really think about it, with rates being so low, even if you're more of into the kind of multifamily, let's say flipping space, just think about being able to sell your apartment building, your multifamily development down the road with 2.5, 2.89 financing, right? That's fixed, and it's long-term fixed. And so there's a lot of different programs within HUD. There's supplemental loans, there's healthcare loans, acquisition, construction. Right now, in the current market, multifamily is the really kind of booming industry where you're still getting very high leverage. I encourage you to reach out to me and we can discuss your project. But I truly think you need to look at this financing tool and put it in your tool belt, because as I start talking with more and more real estate investors and syndicators and developers, once they kind of get, what's available to them, they're really, really intrigued. And, we're getting a lot of great interests and we're closing a lot of deals. So anyways, that's it for today's episode. And this was all about multifamily construction. And we also have other solutions. Maybe it's not a good fit for HUD right now, but they just waived their 3-year look-back period. So prior to a new construction project, you'd have to wait 3 years once it was stabilized, once it was rented up, to refinance with HUD. Well, now that's been waived. So once you get the occupancy up and the debt service coverage ratio is over 1.17, there's definitely an option to refinance right away. So we also could potentially do a bridge construction loan to HUD. So there's a lot of different options, and I wanted to just share with you, and look forward to connecting with you over the next couple days, weeks, months. Hope you're staying safe, and I hope you enjoyed this episode.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.